This episode is sponsored by Lendlord. Lendlord is an online platform designed to help landlords and property investors manage, track, and optimize their real estate investments. Lendlord has a whole suite of free services, including a deal analyzer, property flipping calculator, tenant CRM, profit and loss reports, and so much more. I personally use Lendlord to track all my rental properties. Think of it as a modern day upgrade to boring old spreadsheets. Lendlord also has useful tools to analyze real estate deals, allowing you to calculate cap rates, IRR, and annual cash flows. It's completely free, so check out the link in the description below and let me know what you think. Hey, Saretsky here. Welcome back to the show. I want to touch on this week on what's happening in macro markets, give the high level overview, and sort of explain how I see that framing up into the Canadian housing markets. I do get a lot of questions about, what's happening in the housing market. There's been a lot of volatility over the past 12 months. When should I lock in my mortgage rate? Should I be adding to my portfolio? Should I not be adding to my portfolio? And so I'm going to kind of deviate a little bit from the sort of just the news cycle and give you sort of an overview of kind of how I'm looking at the market right now on the Canadian housing front. So we've got this volatility, and it's been a very wild ride really over the last several years, right? I mean, this has not been a normal housing market. It's been, down at the start of the pandemic, up, houses prices doubling in the suburbs. Then we see the sharpest correction on a national level in going back 30 plus years. And all of a sudden this, 2023 flips the corner and we get house prices back up, double digits. So this has not been like a normal market by any stretch of the imagination. And so I kind of want to touch on that a little bit, but what we're seeing at the moment is this rate volatility in the bond market that's predominantly due to the debt ceiling, right? There are some fears in the markets about, okay, is an agreement going to be reached, et cetera. I think people are over exaggerating. The debt ceiling has been renegotiated 100 times since the 1900s. So it's not unusual, but obviously the negotiations are heating up and time is becoming of the essence. But you're getting this spike up in yields that's flowing through into Canadian mortgage rates. We've seen most Canadian banks raising mortgage rates by about 10 to 15 basis points over the last couple of weeks. But in the grand scheme of things, we've essentially been range bound on mortgage rates for the last 7 or 8 months. Of course, that's what's brought some stability to the housing market. Is because we've had some rate certainty, right? The Bank of Canada moved to the sidelines, fixed rates basically leveled out and dropped off a little bit. And so that's provided some level of stability. But the reality is you still got mortgage rates basically stuck more or less at 5%, almost regardless of whatever term you're going with. Remember, because the yield curve is flat, is actually inverted, it's kind of mixed up all the mortgage rates, right? Again, typically your 1 year term, your 2 year term are cheaper than your 4 or 5 year term, but that's actually the opposite of what we're seeing today, given the inverted yield curve. So you've got that going on at the moment. Now, keep in mind, the Bank of Canada came out with some important information last week in their financial stability report, which noted that one third of all mortgages in Canada have actually not seen a payment increase. They have not seen a payment increase despite 400 plus basis points of rate hiking, because you got a lot of mortgages that are fixed on fixed rates. You've got people that are on fixed payment variables where the banks are essentially deferring the interest and not actually increasing people's monthly payments, which is basically just kicking the can down the road. People are freaking out about that. So let's unpack that basically, because there was a report that from Desjardins which noted that 40%, it would require it requires a 40% increase by 2025 or 2026 for people to remain at their current amortization levels. So if they don't want their amortization to grow, their payment's going to have to increase by 40%. That's what they're modeling. Now, the reality is things are going to change. People that are on these fixed payment variables, if you're a young first-time home buyer that's in a one-bedroom condo, in 3 years, you might just be upsizing anyways and getting a larger mortgage and moving your mortgage anyways. So that's not going to matter at all. Yes, you won't have paid off any interest, but in the grand scheme of things, again, if your income's growing, if your down payment's growing, etc., that becomes essentially a non-issue. You got people that can convert to fixed rates tomorrow at any time. that basically alleviates the problem. Of course, you're going to have a payment increase. But so that, I think that story, in my opinion, is overblown. I think it also doesn't take into account that where our rate's going to be a year from now, 2 years from now. It's great to model things in a spreadsheet, but as we can see again over the last 3-4 years, the world is incredibly hard to predict. And so there's a lot of things that can change that outlook. So I believe that it has the potential. I'm not saying it's the likeliest outcome, but I think that has the potential to become similar to the mortgage deferral cliff, which is basically a non-issue. Everybody freaked out. Mortgage deferrals reached 18% of all mortgages outstanding. Housing market kept going up. Basically, this got swept under the rug. A sea of liquidity. Nothing happened. Are we going to that same scenario with this deferred interest on all these variable rate mortgages? Not necessarily convinced, but I also think regulators such as OSFI could stroke a signing of the pen next week and suddenly rewrite the amortization schedules and how banks have to deal with those. So there's a lot of possible scenarios that I think it's premature to overreact to 2025, 2026. Now, what I will say is it is proving that inflation, or at least the readings that we're getting from government, is staying elevated for longer. I still think there are lots of risk in this country's housing market. I think that my personal view is I think the economic data is actually weaker than what it's probably showing today. I actually think inflation is lower than what a lot of these metrics are showing today. Now, again, I agree. Yep, the basket is massaged. It's been underreporting inflation for the last decade. I certainly think that's true, but I think the official readings that you're getting today, I actually think are lagging and not showing the true extent. When you actually talk to people that are running businesses, you read into some of these investor presentation reports from publicly traded companies, you see what's happening behind the scenes. I see what's happening in the real estate space, developers pulling back. We're seeing easing of costs on construction costs. You have some trades starting to look for work. So I think the underlying is the economy is actually weaker than it is being portrayed. Inflation, if you look at the Trueflation metric, which is a private index, it's got inflation which had peaked at about 11.5%. They've got it down to 2.9% as of today in the U.S. And I think Canada, again, is somewhere similar. So my view today is that the economy is weaker than policymakers are aware of, but they're going to pivot late. There's not going to be a sudden pivot this year, as we can see, despite banking crises and issues in bond markets, etc. The central banks have been reluctant to cut interest rates. And so I do believe that it's going to be a higher for longer scenario. And under a higher for longer scenario, I still think we've got some dead bodies that are going to float to the surface. You can't take on this amount of debt in this country, push house prices to these levels, and then suddenly raise rates by 400 plus basis points in less than 12 months and expect, a 9-month correction, and then we're on to the next bull market. I am still incredibly cautious. So in terms of adding to a portfolio, for example, it's not something I'm actively looking. I still think it's wise to have a relatively stronger cash position today. And so that's kind of how I'm looking at it. I think that, I know the industry is getting all bulled up because we did have a spring market, but that spring market has been largely based off of low volumes. You've got a 20-year low in new listings, which is basically supporting price levels. If you didn't have a 20-year lows in new listings, I would argue that inventory would have been able to build to a level which would have put downwards or continued downwards pressure on pricing. But again, sellers moved to the sidelines. It has deprived new listings. Inventory has shrunk to multi-decade lows. And when you get multi-decade lows, and the reality is you're always going to have some demand in the housing market, prices have actually been pushing back higher. Now, we're now out of the spring market. We're moving into the summer market, which is historically a time when the market cools and slows down. And so I think it's something to continue to bear watching, because I do still think that there's a real risk that the economy could roll over, and that could create some job losses, some economic weakness, push a few more listings to the market, allow inventory to slowly build over many, many months, and maybe get a leveling off in prices or a decline in home prices. So I still think that is a real, very real scenario, and a lot of this is going to come on the trajectory of interest rates. My view is that rates are coming down in 2024 because I do think we are entering, arguably, potentially even in a recession already. It's going to, but you're probably not going to know it until the data is revised several quarters later, like we just saw in Germany, where they revised Q1 data lower to now say, okay, yeah, Germany's officially in a recession. So I think that is the likelihood path for the Canadian market. So I see rates being lower next year. But I think that central bankers are going to be very slow to pivot, just as they were slow to hike when inflation was clearly, we talked about in this channel several years ago, right? Which it was like, hey guys, house prices are up 30% on a year-over-year basis. Inflation is glaring us in the face, and central banks are saying, well, not to worry, it's transitory. I think it's the exact opposite this time around. I think that there's a lot of noise out there, but I do believe that inflation is coming down in a material way. Again, it's not to say that things get cheaper, but prices stop going up. So when things get cheaper, that is outright deflation. We don't, in my opinion, we don't have outright deflation. We have disinflation, which is basically things are going up at a much slower pace. They're not going up 10% anymore. Okay, they're only going up 2 or 3 or 4% on a year-over-year basis, and I still believe as interest rates work their way through the system, that you're going to see demand slow in the overall economy, and that is going to bring recession and lower rates. So again, as I mentioned before, people are wondering, well, what's going on with the housing market? Again, only 1/3 of all mortgages outstanding have actually seen a mortgage payment increase. You've got, keep in mind, of your primary residence owners in this country, something like 35% of all primary residences in this country are mortgage free. There's no debt. They're mortgage free homes. And then on top of that, again, 1/3 of mortgages outstanding have only seen a payment increase. So this is going to take time to filter through the system. You think about people that are on private mortgages, which are typically 1-year terms. Well, again, if you took out a 1-year private loan last June at 5.5-6%, that's going to renew in June of this year at 10%, and that might require a liquidity injection because they might just say, hey, listen, your loan to value is impaired, is down. It's no longer a 75% loan to value loan. It's now a 65, and we require more equity into the property in order for us to renew your mortgage. So again, these are the risks that are happening in the market. And again, we can overlay this and continue to go down this path. The wild card on the flip side remains immigration, the ability to adequately supply housing. I still think structurally the housing supply channel in this country is utterly broken. The fact that it takes 18 months to get a permit for a duplex or 3 years to rezone a parcel to convert it to condo development land, that's insane. And that is systemically broken, that I have yet to see any level of government, despite all the talk and the commotion about it, has not resolved. So structurally, you have that in the background. But in the near term, over the next 12 to 18 months, I do worry about where the economy is going, because my view has always been the ability to raise interest rates. And it's interestingly enough that you're seeing this clear view in the debt ceiling negotiations. The fact that the government is saying, listen, we are not going to be able to pay our bills as of January 1st unless we raise the debt ceiling and issue more debt to pay the old debt. That basically just tells you like how indebted not just governments are, but just the global economy. Again, the U.S. Failing. As interest rates go up on the debt, the government starts paying more interest to service the existing debt. And so the interest burden as a percentage of GDP has been steadily rising and requiring more debt to service
the debt payments on the existing debt. So it is like, yes, it is sort of Ponzi financing, and this is just at the government level, but you can think of that similar in the household sector as well. And so again, if governments are struggling, I just don't see how most of these economies can continue to operate functionally so long as rates are at these levels for a prolonged period of time. And again, we haven't necessarily seen a whole ton of carnage. We've seen some, but we haven't seen a whole ton of carnage, because the reality is it's only been about 12 months, and a lot of this rate hiking mechanisms haven't actually fully filtered through into parts of the economy, again, such as housing. So we'll see. Things I'm monitoring. I still think there's caution. Again, it's hard to see house prices going down when you've got 20-year lows in inventory. So until that gets resolved, but I think that will in time likely get resolved as the economy softens, and as sellers who are holding back 20-year lows in new listings, I think will eventually at some point start to test the market. And so there's a possibility, again, for more volatility in the housing market. But this is kind of how I'm looking at things as of right now. And we'll continue to update you as things move forward. So hope that helped. As always, we'll see you next week.